There are 143 ounces of silver being traded on paper for every single physical ounce that actually exists in a vault. Let me say that again. If you own silver through an ETF, a futures contract, or a pooled account at a major bank, there's a 93% chance the metal you think you own doesn't exist. Not because someone stole it, not because of some elaborate conspiracy, but because the financial system was designed this way on purpose. And most people holding paper silver have absolutely no idea. In March 2020, when the pandemic hit and markets seized up, the price of physical silver and the price of paper silver split apart by almost $9 an ounce. For about 72 hours, the two markets completely disconnected. You could sell paper silver for $24, but if you wanted to buy a physical bar, you'd pay $33. That wasn't a glitch. That was the system showing you what it really is. And right now, that gap is starting to open again. Most people think silver is just gold's cheaper cousin, a shiny metal people buy when they can't afford the real thing. But silver is something entirely different. It's the most conductive metal on Earth. It's in every solar panel, every EV battery, every 5G tower, every missile system, every medical device, every RFID chip. The world uses about 1 billion ounces of silver every year, but we only mine about 820 million ounces. That deficit gets filled by recycling and above-ground stocks, and those above-ground stocks are shrinking fast. Here's where it gets interesting. Silver trades in two completely separate universes. There's the physical market, where actual metal changes hands, refineries, mints, industrial buyers, retail investors, real bars, real coins. Real delivery. Then there's the paper market, futures contracts on the COMEX, exchange-traded funds, unallocated accounts at bullion banks, derivatives, swaps, options on futures, synthetic exposure that's supposed to track the price of silver but does not require anyone to actually own it. The paper market is about 50 times larger than the physical market, maybe more. No one knows the exact number because no one's required to report it. And here's the thing, the paper market sets the price, not the physical market. When you check the price of silver, you're looking at the COMEX futures price. That's a price discovered by traders buying and selling contracts in New York and London. Most of those traders will never touch a bar of silver in their lives. The physical market just follows along, until it doesn't. Let's talk about how this system actually functions, because once you see it, you can't unsee it. When you buy a silver ETF, you're buying shares in a fund that claims to hold physical silver in a vault somewhere. The largest one is SLV, the iShares Silver Trust. It holds about 500 million ounces. That sounds like a lot. It is a lot, but look closer. The silver is held by a custodian, usually a bank. You don't own the metal. You own shares in a trust that owns a claim on metal held by a bank. You can't redeem your shares for physical silver unless you're an authorized participant, which means you're a major financial institution moving in 50,000-ounce blocks. The prospectus openly admits the custodian can lease your silver to third parties. They can lend it out, rent it, hypothecate it. That's the technical term. It means using the same asset as collateral for multiple transactions. So the silver you think you own might also be backing someone else's short position. Now let's go deeper. The COMEX is where silver futures trade. A futures contract is an agreement to buy or sell silver at a specific price on a specific date. Most contracts never result in delivery. Traders close them out before expiration. They're not buying metal, they're speculating on price movement. But here's the important part. You can sell a futures contract without owning any silver. You can short the market by promising to deliver metal you don't have. As long as you close the position before expiration, it doesn't matter. This is how price gets controlled. Not through conspiracy, through market structure. When silver starts to rally, a few large players can dump thousands of contracts onto the market in seconds, usually during low liquidity hours. Asian trading session, Sunday night, 3 a.m. in New York. The price spikes down. Stop losses trigger. Momentum breaks. Rally dies. This happened in February 2021 during the Reddit silver squeeze. It happened in 2011 when silver hit $50. It happened in 2008. It's happened dozens of times. The pattern is always the same. Large short position appears out of nowhere. Price graders, shorts cover at a profit. Repeat. The CFTC, which regulates commodity markets, has been investigating silver manipulation for over a decade. They've fined major banks hundreds of millions of dollars for spoofing. That's the practice of placing fake orders to move the price, then canceling them. JP Morgan paid nearly $1 billion in fines for precious metals manipulation between 2011 and 2018. They admitted guilt. Traders went to prison. But the structure didn't change, because the structure is the point. Here's why this matters. The concentrated short position in silver is extreme. A small number of banks hold a massive percentage of the short side. The latest CFTC data shows 4 traders account for nearly 40% of the entire commercial short position. 4. Those aren't random speculators. Those are institutions with balance sheets in the trillions, and their short position isn't a bet that silver goes down. It's a hedge against the long exposure they have through ETFs, allocated accounts, and unallocated client holdings. They're short because they've sold more silver than they can deliver. If everyone asked for physical metal at the same time, the system breaks. Let's run the numbers. And this is where it gets uncomfortable. Total global silver inventories that are available for investment, held in vaults that report their holdings, add up to roughly 2.5 billion ounces. That includes COMEX warehouses, ETFs, and allocated storage at major dealers. Sounds like a lot. But now look at the other side. The open interest on the COMEX, meaning the total number of outstanding futures contracts, represents about 1 billion ounces. SLV holds 500 million ounces. Other ETFs hold another 300 million. Unallocated accounts at banks, private vaults, and allocated accounts that don't report publicly probably hold another billion ounces in claims. We're already at 2.8 billion ounces in paper claims against 2.5 billion ounces of physical metal. And that's just what's visible. It doesn't include over-the-counter derivatives. It doesn't include swaps between banks. It doesn't include synthetic positions held off exchange. If you include estimates for those markets, some analysts believe the ratio is closer to 100 ounces of paper claims for every physical ounce. But let's be conservative. Let's say it's 50 to 1. That means if just 2% of paper holders tried to convert to physical at the same time, the system implodes. 2%. This isn't theory. We've already seen it happen in smaller markets. In March 2020, the gold futures market nearly broke. Delivery demands spiked. Refineries were closed because of lockdowns. Transport was shut down. Suddenly, people holding futures contracts couldn't get metal. The COMEX changed the rules mid-game. They allowed delivery of non-standard bars, 400-ounce London Good Delivery bars, instead of the usual 100-ounce COMEX bars. That's like paying your mortgage with a different currency and calling it equivalent. It worked because everyone pretended it worked, but it revealed the truth. The paper market is a ledger. The physical market is reality. And when reality asserts itself, the ledger bends. Silver is worse because the market is smaller. The entire annual global silver market, physical and paper combined, is about $1 trillion. That's nothing. Apple's market cap is $3 trillion. One large fund could move the entire silver market if it wanted to. The reason silver stays cheap isn't supply and demand. It's systemic leverage. And leverage works great until it doesn't. Here's the timeline no one's talking about. Industrial demand for silver is accelerating. Solar panel installations grew 30% year over year in 2023. EV production is doubling every 2 years. Every new data center uses thousands of ounces of silver in bus bars and circuits. Meanwhile, mine supply is flat. Most silver comes as a byproduct of copper, lead, and zinc mining. You can't just open a silver mine when the price goes up. It takes years, permits, capital, infrastructure. The deficit between supply and demand hit 200 million ounces last year. That's the largest deficit in decades, and it's getting worse. Normally, that would send prices soaring, but the paper market absorbs all the pressure. You can create infinite paper silver with a keystroke. So the price stays pinned until someone asks for delivery. Let's talk about what's happening right now. Not speculation, not hype, just data. The Shanghai Futures Exchange, where Chinese traders buy and sell silver, has decoupled from COMEX pricing multiple times in the last 18 months. For hours at a time, silver in China trades 2 to 3% higher than in New York. That's not supposed to happen. Arbitrage should close that gap instantly. But it's not closing because there's no physical metal available to move between markets fast enough. Premiums on physical silver coins and bars have been elevated for 3 years. Pre-2020, you could buy a 1-ounce American Silver Eagle for $2 over spot price. Now it's $6 to $8. That's a 300% increase in premium. Dealers will tell you it's just demand. But demand doesn't explain why you can't get metal even when you're willing to pay the premium. Wait times for large orders are 6 to 8 weeks. Mints are rationing, refineries are running at capacity. First Majestic Silver, one of the largest primary silver miners in the world, stopped selling metal to banks in 2021. The CEO said publicly he wasn't going to sell silver at suppressed prices when he knew the real value was higher. So now they hold their production and sell directly to retail. When miners stop selling to the price discovery mechanism, that's a signal. In India, which is the largest importer of silver for jewelry and investment, premiums spiked to 12% earlier this year. 12%. That's not a functional market. That's a shortage being masked by paper price control. And then there's the COMEX warehouse data. Eligible silver, which is metal available for delivery against futures contracts, has dropped by 30% since 2021. Registered silver, which is already earmarked for delivery, fluctuates wildly week to week. Here's what that means in English. There's less metal in the warehouses. And what's there is being moved in and out faster than ever. High velocity. That's what you see before a system breaks. The banks know this. They're not stupid. So what are they doing? They're tightening margin requirements, making it more expensive to hold leveraged positions. They're raising premiums on unallocated storage. Some are quietly converting customer accounts from unallocated to allocated, which means separating specific bars instead of just holding a pooled claim. Why? Because unallocated means they can lend your metal out. Allocated means they can't. If they're shifting to allocated without being forced to, it's because they're worried about a run. You don't buy insurance after the house is on fire. Here's another crack. Bullion banks used to make money on the spread between buying and selling physical metal. Tight spreads, high volume, low risk, but spreads have blown out. In some cases, the bid-ask spread on large bars is 3%. That's chaos. When market makers widen spreads, it means they don't want to hold inventory. They don't trust their ability to hedge. They see risk they can't price. The entire structure is built on confidence. Confidence that the paper price represents the physical price. Confidence that if you need metal, you can get it. Confidence that the system has enough physical inventory to cover redemptions. But confidence isn't infinite, and right now it's being tested. Let's zoom out. What happens if the system actually breaks? The first stage is what we saw in 2020. Price dislocations, premium spike, physical and paper markets diverge. People holding paper contracts demand delivery. Some get metal. Most get cash settled at the paper price. They're told there's a temporary shortage, transport issues, refinery delays. It'll clear up soon. But if the pressure continues, you move to stage 2. ETFs suspend redemptions. They cite force majeure, extraordinary circumstances. The prospectus, which no one reads, has a clause that says they can do this. SLV has it. Most ETFs have it. You still own shares, but you can't convert them to metal. The price on your screen says $28, but you can't access it. You're locked in. Stage 3 is a default. A major bank or clearinghouse fails to deliver on a futures contract. The COMEX declares an emergency. They cash settle all contracts at the last traded price. No physical delivery. You get dollars, not metal. The paper price might stay stable or even drop because the paper market is still trading, but the physical price explodes. $50, $70, maybe more. The two markets fully decouple permanently. At that point, anyone holding physical silver is in a different asset class than anyone holding paper. The paper becomes what it always was, a derivative, a claim on a system that no longer functions. Now, does this have to happen? No, the system could keep limping along for years, decades even. As long as industrial users can get metal and retail demand stays manageable, the leverage can persist. But the math is getting harder to ignore. The deficits are real. The inventory drawdowns are real. The premiums are real. And leverage, by definition, is fragile. Here's the irony. The very mechanism that keeps silver cheap is what makes it vulnerable. The paper market suppresses price by absorbing demand, but it also creates a massive overhang of claims that can't be satisfied with physical metal. It's a spring being compressed. The more you push it down, the more energy you store. And at some point, something gives. You might be wondering, why doesn't someone just fix this? Why doesn't a regulator step in? Why don't the banks reduce their short positions? Because there's no incentive. The banks make money on the spread. The leverage lets them earn fees on metal they don't own. The paper market keeps prices stable, which is good for industrial buyers and governments that want to avoid inflation signals in commodities. Everyone benefits from the current structure, until they don't. The CFTC has known about concentrated short positions for 15 years. They've held hearings. They've fined banks. They've done nothing structural, because fixing it would mean admitting the market isn't real. And once you admit that, trust evaporates. Here's what makes this different from other financial bubbles. When stocks crash, you lose money. When housing crashes, prices drop. But when a commodity market built on paper claims collapses, you lose access to the underlying asset. Silver isn't just an investment. It's a material input for technology, defense, medicine, energy infrastructure. If the price discovery mechanism breaks, the entire supply chain stutters. Imagine solar panel manufacturers unable to source silver at any price because the futures market they relied on for hedging no longer reflects reality. Imagine electronics companies bidding against each other for spot metal while the ETF price stays frozen. That's not a market. That's a crisis. Let's talk about the scenarios people don't want to discuss. Scenario 1. A major sovereign fund or central bank decides to take physical delivery of a large futures position. Not to manipulate the market, just because they want the metal. China, India, Saudi Arabia. Doesn't matter who. They have the money. They have the legal right. They stand for delivery. The COMEX scrambles to find metal. They tap the warehouses. They call refineries. They offer premiums. But there's not enough. Not even close. So they cash settle. They pay the fund in dollars at the contract price. The fund protests. It goes to court. Meanwhile, every other futures holder realizes the contract isn't enforceable. Trust collapses. The paper market freezes. Scenario 2, a financial crisis hits. Liquidity dries up. Banks need to raise cash. They start liquidating positions. But their silver short is a hedge against long exposure in ETFs and allocated accounts. If they close the short, they're exposed to a price spike. If they don't close it and the market moves against them, they face a margin call. Either way, they're trapped. In that scenario, the bank doesn't try to manipulate the market. They just try to survive, and in doing so, they stop providing liquidity. The market seizes. Scenario 3, an exogenous shock. A war that disrupts refining capacity. A government that nationalizes silver production. A cyber attack that takes down exchange infrastructure. Something no one predicted. Suddenly, the just-in-time supply chain that keeps the paper market functioning breaks down. Physical delivery timelines extend from weeks to months. Premiums explode. And the fiction that paper equals metal becomes impossible to maintain. In every scenario, the trigger is different, but the outcome is the same. The leverage unwinds. And when leverage unwinds in a commodity market, it doesn't happen slowly. Here's what most people miss. The paper-silver market isn't fraudulent. It's fractional. Just like banking. Your bank doesn't keep all your deposits in a vault. They lend most of it out. As long as everyone doesn't ask for their money at the same time, it works fine. But if there's a run, the system needs a backstop. The Federal Reserve, deposit insurance, a lender of last resort. The silver market has no backstop. There's no Federal Reserve for commodities. No deposit insurance for futures contracts. If there's a run on physical silver, there's no one to call. The COMEX can change the rules. They've done it before. They can increase margins, suspend trading, force cash settlement. But those are emergency measures. Once you use them, you admit the system is broken. And once trust is gone, it doesn't come back. The interesting thing is, the banks probably don't want this to happen either. They're not evil. They're just operating inside a structure that incentivizes leverage. They make money when the market is stable. A collapse would hurt them too, but they're stuck. If they try to unwind their short positions all at once, the price spikes and they take losses. If they don't unwind and the market breaks, they face delivery failures and legal liability. So they do what all institutions do when trapped. They keep playing the game and hope something changes. Let's bring this back to you. If you own paper silver, should you panic? No, panic is never useful, but you should understand what you own. If you hold SLV or another ETF, you own shares in a trust. You don't own metal. You can't take delivery unless you're moving institutional size blocks. In a crisis, redemptions can be suspended. If you hold a futures contract, you have a legal claim to metal. But if the counterparty can't deliver, you'll get cash at a price set by a market that no longer functions. If you hold physical silver, you own a physical asset. No counterparty risk, no leverage, no one can suspend it. But you also can't sell it instantly at the paper price if the two markets diverge. The question isn't which is better. The question is, do you know what you own? Most people don't. They see a silver ETF and assume it's equivalent to holding a bar. It's not. It's a derivative. And derivatives only work when the system functions. The bigger question is, why does this matter now? Silver has been leveraged for decades. The paper market has always been larger than the physical market. What's different? 3 things. Industrial demand is accelerating faster than supply can respond. Geopolitical fragmentation is making supply chains less reliable. And monetary policy is creating an environment where hard assets become attractive. None of those trends are reversing, which means the pressure on the physical market is only going to increase. The paper market can absorb that pressure for a while, but every time it does, the spring compresses a little more. Here's the uncomfortable truth no one wants to say out loud. The paper-silver market is the financial system showing you what all modern markets have become: abstracted, leveraged, disconnected from the physical world. Most people own stocks through a brokerage. You don't hold share certificates. You hold a claim on a claim. Your money is in a bank account, not in your hand. You think you own real estate. But it's encumbered by debt, taxed by governments, and regulated by authorities who can change the rules. Everything is paper. Everything is leverage. Everything depends on trust. And silver is just the clearest example, because it's a physical metal that can't be printed. It either exists or it doesn't. And right now, the market is pretending it exists in quantities it doesn't. At some point, that pretense ends. Not because someone decides to end it, but because the math stops working. When that happens, paper silver won't collapse overnight. The market will keep trading. Prices might even stay stable, but the connection between paper and physical will break. And once it does, the two will never reconnect at the same ratio. The people holding physical will be fine. The people holding paper will learn a very expensive lesson about counterparty risk. So where does that leave us? The The silver market is a stress test, a test of whether financial abstraction can persist indefinitely, a test of whether markets can remain disconnected from physical reality. And right now, the test is getting harder. The banks know it, the regulators know it, the miners know it, the industrial buyers know it. Everyone involved in this market sees the cracks. But no one wants to be the first to say it out loud, because once you do, the trust evaporates. And trust is the only thing holding the system together. So they keep trading, they keep hedging, they keep pretending the paper represents the metal. Until one day, it doesn't. And when that day comes, it won't be a slow realization. It won't be a gradual repricing. It'll be 72 hours of chaos, just like March 2020. Except this time, the system won't be able to patch itself. Because the inventory isn't there, the physical metal isn't there, and no amount of paper can change that. The simple reason paper silver can collapse overnight isn't complicated. It's math. You can't have 100 claims on the same ounce of metal. Not forever. The only question is when